Ian has had various roles in outsourcing management with Novartis, Merck, and most recently Boehringer Ingelheim. And Ian will introduce the panel. Thank you, Dick.
Thank you, Gareth. Thank you all for attending. This should be an interesting presentation. We've all seen the consolidation that's been going on in our industry for the past 12 to 24 months, and it seems to have slowed down a little bit, but we're going to bring up some very special guys who've been in this industry for quite a while on Wall Street and are sort of behind the driving force of what we've seen over the last 2 years with private equity purchasing CROs and looking at other strategic providers. We have a CEO from a large CRO as well who can give perspective, who's been through an acquisition and has gone from a public to a privately traded company and acquired by private equity, and also an investment banker who goes through mergers and acquisitions quite a bit. So without further ado, if I could bring up the panelists. First, I'd like to introduce Eric Colwell. He's a managing director at Robert W. Bard & Company. So Eric, if you could just say hello and give a 2-second background.
Great. Thank you. Nice to see everyone again. I've presented at this event several times in the past. Hopefully we'll give some good information. I've covered the CRO sector for about 17 to 18 years now. So good to be back.
Thank you. We also have David Windley, who is a managing director of healthcare equity research at Jefferies & Company. So, Dave?
Hello. Thanks for having me back. I could ditto what Eric said, but I have been here several years also. I'm with Jefferies & Company and have followed the CRO space for 13 or 14 years myself, and also dabble a little bit in healthcare IT and managed care.
So these guys are on Wall Street, and they'll be able to help us look at the numbers and see what the driving force is behind this. Our next panelist, Jonathan Leff, is a managing director at Warburg Pincus. He is private equity, and he will be able to tell us exactly what these guys are looking at while they're acquiring the CROs. So, Jonathan?
Hello, everyone. Thank you. Jonathan Leff with Warburg Pincus. We are a major private equity firm. I've been with Warburg for 16 years, and for the last 12 years or so have led the firm's investment effort in the pharmaceutical industry, including pharma outsourcing. So look forward to sharing some perspectives with you today.
Thank you. Next, we have Michael Martorelli. Michael is a traditional investment banker who helps with mergers and acquisitions. So, Michael? With Fairmount Partners out of Pennsylvania, my hometown.
Thank you, Ian. And like David and Eric, I'm another long-time participant and attendee at this meeting. Fairmount Partners is an investment banking firm. In addition to participating in all the investment banking deals in the pharmaceutical outsourcing space, I still write some industry research, having been a colleague of, or a competitor of David and Eric's a long time ago. I still do a little bit of that, but not with stocks, just with industry news.
So last but certainly not least, we have with us Jeffrey McMullen. Jeffrey was president of PharmaNet, and with the recent acquisition by Inventive is now the CEO of PharmaNet/i3, and he's been through public to private, being purchased by private equity, mergers and acquisitions, so he's a great guy to have up here because he's lived through just about all the things we're going to discuss today. So, Jeff?
Thanks. And yeah, the key word there was I lived through all those things. I am still standing. I've been in the industry for about 35 years, started on the pharmaceutical side and moved to the CRO side about halfway through that career. One of the founders of PharmaNet and now president and CEO of PharmaNet i3. Look forward to having a conversation with you today. Thanks.
Great, thank you. So we're going to have a mixture of people being seated, people getting up to keep moving and not get stale. So as we've said, we're going to go through in this order. So we're going to give the Wall Street perspective, then the PE, an investment bank, and then the CRO perspective. And then I'll chime in a little bit, being around at several different sponsor companies, doing outsourcing for about the last 11 years, and can talk a little bit about the impacts we see and the concerns that sponsors have when we see movement on the private equity side and purchasing these companies. And we would like to end with an interactive session where you guys will get up and hopefully ask some questions and such, because We have some great access to some great people here who do this on a daily basis, so I'd like to really get you guys engaged and help you answer, get your questions answered for what you're seeing and interested in as well. So without further ado, we're going to start off with Eric Colwell.
Just show me how this works.
Green is forward, red is backwards.
Are we going? On the big board? There we go. Okay. You'd think I could do this. Well, I thought about the event today and I said, okay, I'm not going to step on anybody's toes and I'm going to say something funny. I haven't come up with anything funny to say, but hopefully I won't step on anybody's toes. Showed up yesterday feeling pretty good. I was depressed by 3, felt good again at 4, depressed by 5, had a couple of drinks, felt pretty good. Not so good this morning. I think we're probably all going through the same thing in this industry. Dave and Mike and I as observers more than participants perhaps. But one very smart person I met with earlier today was kind enough to give me the quote that I'll steal, which is, it feels like we've been walking in an earthquake for the last 4 years. And I think that's pretty appropriate. A lot of change in this industry. Pharma's experimenting with different outsourcing models, whether it be tactical, programmatic, functional service providers, strategic contractual minimum volume, virtual trials. I'm not even sure that those names mean much. There's a lot of semantics out there that seem to be the same things with different clothing. Biotechs obviously have good capital raises one quarter, and the next quarter the market dries up. And then 10 of them are acquired and things change again. I think there are some things that we do know, and I'm going to try to focus on those, and we'll save the questions that hopefully we run out of time and we can't answer. We'll save the questions or the answers to some of the more complex things for a Q&A. I'm going to start, Dave's going to follow up. I'm going to start with what's actually been happening. I've done this several times in the past. I think the 2011 summary is that we had slightly higher cancellation rates in the last few years. Some pretty tough comparisons as well, but also we have had very slow revenue conversion in this industry despite bookings coming back now beginning in the fourth quarter of 2009. As a result, the industry backlog has been growing, especially on the publicly traded side of the market. You have a group that has seen awards peak and then trough off and then peak again in the last several quarters. It's been incredibly volatile, but the one thing that's been constant is that revenue has not been growing among most of the larger companies, both public and private. Fits and spurts, but in aggregate, it's been very, very slow on the top line. There's been a lot of talk about these strategic awards. I put quotes on them because I don't really know what a strategic award means, and I don't think we have a common definition at this point, but let's call it big deals. And they certainly, many of the contracts have become more comprehensive. They've become more complex, more global, more multi-phase. The fact is that we are seeing an increase here recently in RFP values. Volumes overall appear to be stable-ish. And I'm going to use the word ish a few times, but stable-ish, maybe up a point or two, but the RFP values have increased. Backlog growth rates, as I said, have been very volatile, but they've been up about 15% on average for the larger companies since the trough in the middle of 2009. And the backlog coverage continues to set new highs. Right now, backlog coverage defined as all future backlog divided by the industry's next 12-month revenue forecast, it's about 250%. It's never been this high. Typically, that would suggest very high visibility into future demand, but I think we've all been scratching our heads for the last few years wondering when the rubber's going to meet the road. We do a very large survey at Baird. I think David does a large survey as well. I know several of the analysts do. We actually use an outside party to contact many, probably some of you. We have about, last year we had a total of over 400 respondents. These are people out of pharma and biotech that have to have at least 2 years of industry experience at their company so they can have some trend analysis. And I'll give you a quick example of what happened last year. I came into the year assuming that some of the budget cuts among the larger pharmas in particular would lead to global R&D growth roughly flat, and I'll use the term ish again, flat-ish, up or down a couple of points. It was a little better than I thought. In the client survey in the first half, in the actual sponsor community came back to us and said they expected R&D budgets to be up modestly. In the second half of the survey, The response rate actually for a couple hundred respondents was that they expected their budgets for the full year to be up about 8%. Now, a lot of caveats around that, including I'm only surveying people who still have a job. And you know, not everybody still has a job, not every compound is still progressing, so you've got to discount those numbers somewhat. But my best guesstimate is that R&D budgets were flat up about 2% in total for 2011. Outsourcing penetration clearly going up. You can see it in the backlog numbers, you can see it in the conversations. I'm not going to claim that every pharma and every biotech is going to increase their number in the future, and I wouldn't be surprised if occasionally there's one or two that talk about insourcing more work. But the fact is that our survey is very consistent in terms of outsourcing penetration rates, aggregating across all phases of development. So I didn't parse this out, discovery versus phase 4, etc. But when you look at the global landscape, the total outsourceable budget started the year in the mid-30s. It finished the year in the high 30s. That's up about 9%. My guesstimate, and I guess I'll call it a formal estimate because we're going to be publishing this very soon, is that we're going to be around 40 or 41% this year. So the work is going to increase on the outsourcing side and continue to decrease on the inside part of the equation. I do think generically clients are getting back to work. Many of you went through mergers. You're getting back in business. The economy's a little better. We're more comfortable, maybe not happy with, but a little more comfortable with the global situation. We bring our personal lives to work, as Jeff and I were talking about earlier. And after a couple of years of having the stock market be in the tank and the economy in the tank and the housing market in the tank, things aren't great, but they're certainly not as bad as they were, and we're not as panicked as we were a few years ago. And I think in general, clients are getting back to work. Small client biotech financing's gotten a little bit better recently, a little lumpiness in 3Q, but overall a little better. And when we talk to the sponsor base, what they tell us is that they still prefer North America as the #1 area of investment, but Eastern Asia, led by China, is clearly at the top of the growth curve. It's where they would be putting new money to work. Central and Eastern Europe continue to rank very highly. The UK and Western Europe actually showed the biggest increases. I was very surprised to see a big increase in Western European scores in the second half of last year. About 60% favor clinical as an area of investment over preclinical and discovery. And this is a very equally weighted group of respondents, so there is clearly a favorable approach to clinical over early stage now. Oncology, cardiovascular, immunology, and infectious disease round out the top therapeutic categories. Backlog growth will equal revenue expansion. I'm going to go briefly here for the sake of time, but the bottom line is that revenue growth is accelerating. It accelerated the last 2 quarters. Revenue growth for the CRO industry will be in the double digits in 2012. For the publicly traded companies, there's going to be some volatility. For the private companies, there's going to be some volatility. But if you aggregate the total market, I'm convinced that we're going to be in the ballpark of 10% for the year. The question, and where I'll lead to Dave, is will this revenue growth lead to margin expansion and profit expansion? And I think that's a key that everybody's hoping to answer.
Excuse me. Yeah, so Eric's more bullish than I am, and am I going the right way here? These are, yeah. So he is dealing with the more bullish part. So we decided to divide this up by revenue versus kind of profitability margin. He took the revenue, and I'm taking the margin. So revenue looks positive, looks optimistic. Even kind of the hope can spring eternal when you have backlog growth, as the industry has had. The negative side of that, or what we've seen be the downfall or the shortcoming of the CRO industry's performance, has been the profitability. And the questions that it raises are whether or not that depressed profitability is permanent, transitory, or maybe somewhere in between. So as we think about this on an ongoing basis, but as we in particular thought about that for purposes of this presentation, kind of broke down the areas where we've seen cost increases into 3 or 4 buckets. So one is certainly headcount increases. In a lot of these cases, these strategic deals have prompted companies, CROs, vendors, to either take over staff and rebadging type situations, or to go out and just hire new staff to service the agreement and hire that staff out of the market. And in what seems like 9 out of 10 cases, the revenue that those staff were supposed to be servicing has not come on as quickly as expected. And that's really the piece that Eric showed in the backlog growth outpacing, backlog growth outpacing revenue growth. So, well, what happens in that scenario? You've got the cost, you've committed to the cost, but the revenue is not there to pay for it. So margins have been negatively impacted, and I list several different companies and scenarios that have run into this problem. Secondly, we're seeing a pretty significant investment in information technology. The real standout here in the fourth quarter earnings season was Covance, that announced a multi-year investment in some information technology additions and initiatives that are to improve or impact their clinical business, but also a piece of enterprise resource planning technology that'll snap in the central lab. So regardless of purpose and payoff long term, as we sit here right now and look at the cost structure of the companies, they are being negatively impacted by information technology investments where the hope for the payoff is somewhere out in the future. Another situation is facilities. Now, this is probably a more significant factor as relates to early development, up as far forward as phase 1, but really we see it mostly in preclinical, where there's significant labs that were built up into the peak of the market in 2007 and 2008, and there are some animal rooms in some of those buildings that still have not seen a study. So that to a lesser degree is true in phase 1, but it is a brick and mortar versus study volume imbalance that persists in the marketplace even today. In some cases, that's been exacerbated by sponsors who have tied an award of a study or a package of studies or a strategic partnership to the vendor's willingness to take on a facility. There have been a few examples of that, and in those cases, you're faced with the conundrum of, do I buy the facility because I want the business and I think it's a long-term commitment versus the impact that has on the utilization of one's facilities that have just recently been bought. There's another short list of examples that apply to that situation as well. And then finally, we're seeing situations where companies are recognizing that the development model is structurally changing, and the services required to meet the needs of pharmaceutical clients in those new service areas are different, and building up those services is an investment that has a future, not a current payoff. So in this slide, it looks like we've pushed these together, so that I apologize, the colors aren't great, but what you'll see is revenue growth expanding, backlog or bookings growth on an upward trajectory as well. That one's always going to be a little bit lumpier. But then in the middle of 2008, we hit a peak of margin that we haven't come anywhere near since. So again, I think the question is this a permanent change or a transitory change? And I think our opinion at Jefferies is that it's somewhere in between, that we can and will see some margin improvement, but the likelihood that we get to margins that we're seeing in the middle 2000s is very low. So this last slide is a busy slide, but the point is just to show, if you look at the curves, the point is just to show the change in revenue ramp or activity ramp under these new strategic deals, and the old way on top being receive the RFP, kind of get the award, and within, give or take 4, 5, 6 months, you're kind of ramping up a study to what I think of as a kind of an open mouth, open funnel revenue recognition rate. And today, because these strategic deals contemplate the vendors getting more integrally involved with the sponsor and being involved in protocol design and planning and strategy and country picking and site picking and all those kinds of things, they're getting a look at this business much earlier in the process. And for better or worse, we think that that business has found its way into backlog much earlier in the process, and we've been sitting here waiting for it to come out. The upshot is, maybe it will come out, as Eric has shown. The other side of the coin is there's a much longer period of time for something to change. And you all know this better than I do. But for something to change that would cause the value of that work in the backlog to change or to come out altogether. So we think that these are all issues that are part of the growing pains of the industry that are to some degree yet unanswered, but ones that, again, our opinion is things get a little bit better, but they don't see the peaks that we saw in the mid-2000s. So those were the slides that I had to present. I'll hand it over to the next speaker.
Thank you, Dave. I'll scoot down here to the end since I stole Eric's seat, which is now Dave's seat. So we're going to go next with Jonathan Leff from Warburg Pincus. So we have a team have put together some questions. So he's going to sort of be on the hot seat here as a private equity guy and answer some of these questions that we have. So first one I'd like to ask Jonathan is something that some of us may have some insight into, some of us may not. But why is private equity so interested in the CRO business? It seems like this started back in 08, 09 when the whole economy worldwide was taking a hit, and the trend has continued. So I can sort of combine this with the next one. Is it a follow the leader industry as well? Are we seeing these companies continue to buy other companies because someone started the trend?
Well, thank you for the question. If the question is, are private equity firms like lemmings, the answer is yes. People see a good idea and want to follow that, and we've seen that over the years in many different industries where once people hone in on the industry as being a good one for private equity ownership, many private equity firms follow, and I think to a degree we've seen some of that in the clinical outsourcing arena. I would actually say the trend goes back earlier than the later part of the last decade. I mean, you can really look all the way back to the original take private of Quintiles, which turned out to be a very successful transaction extremely successful for the private equity firms involved in that. And it's fair to say that everybody else in the industry noticed, and people who hadn't paid much attention to pharmaceuticals or pharmaceutical outsourcing looked into it and tried to figure out what made that a successful transaction and whether there were other opportunities. I think then when people take a close look at the CRO industry, the reason it's attracted so much private equity interest is because it has many of the attributes that we look for as classic private equity sorts of investments. We look classically for companies that have stable and predictable cash flow and underlying drivers of growth, as well as opportunities to improve margins over time. And the CRO industry is a good one in that respect because there are certain elements of it that make the future reasonably predictable. You can look at backlog and you can look at the way backlog rolls off into revenue and have a pretty good picture of what the next couple of years are shaping up to look like. So we like that. We like the fact that you're not starting each year over again in terms of trying to build your revenue base. It's also the case that it's an industry where reputation and brand and relationships matter quite a bit. So if you're a leader in the industry today, unless you screw up those relationships and screw up that reputation, you're probably going to be a leader in the industry tomorrow. And that's a good thing. So private equity firms like to buy leaders in the industries that they invest in and recognize that if they run the companies well, if they have the right leadership in place, they can be pretty confident of being able to hold on to a significant market share going forward over time. It's also an industry that does not require enormous capex ordinarily, and there are parts of the pharma outsourcing value chain that do require a great deal of capex, preclinical, for example. But on the clinical side, capex is relatively low, which means there's good, strong free cash flow conversion in the business, which in turn allows CROs to support a substantial amount of debt. And that's another element of the follow the leader aspect of this is lenders. Once lenders see an industry where they've done well. They've financed major buyouts like the Quintiles transaction and gotten their money back successfully. Then they look for more companies in those industries to finance. And certainly the CRO industry, by and large, has been a good one. It has treated lenders well. And so there has been good, strong leverage financing for transactions in this sector, really at healthy multiples, even during times when some other industries in 2008, 2009 struggled to get financing at all. So that's been certainly a factor as well.
So are there bidding wars behind the scenes for both, we know publicly traded companies, that has to be disclosed, you can see that in the SEC filings and such, but when a CRO is private, are there multiple PE firms coming in and, you know, upping the ante, so to speak, if they see a lot of value?
I think the answer to that is yes. I mean, obviously everybody tries to be disciplined on price and valuation, but when people see companies that they like and see companies that have all these attributes I've described, there are a lot of private equity firms out there that are interested in those transactions. So that's why we've seen transactions in the CRO space happen at reasonably healthy multiples, north of 10 times EBITDA in many cases. And believe me, as private equity firms, if we could buy the companies for 6 or 7 times EBITDA, we would. But there's competition, and that drives the process.
So the next question is one that is of particular interest to me. You know, you guys are in business to make money, obviously. You see there's value in these CROs, but what are your short and long-term goals, or a PE firm's short and long-term goals? And when you go in and buy a CRO, do you have an exit plan? Have you talked about that strategy? Do you have a time frame? Is it 3 to 5 years? Can you talk a little bit about that?
Well, I don't think there's a single formulaic answer to that. I mean, every private equity firm has a bit of a different philosophy in general, and then as they go into each transaction, they have a different mindset and a different approach. Even within the same firm, you may see people do a transaction with a 3-year mindset or a 5-year mindset. It really depends on the situation. The one thing that every transaction has in common, and the sense in which PE firms are quite simple animals, is that everybody's trying to make money. I mean, that's the goal at the end of the day, is to sell it for more than you bought it for. So it's as simple as that. In terms of how you get from here to there, there are a variety of different strategies. You know, one, I think, driving philosophy behind a number of the transactions that have taken place, and I think Jeff can probably speak to this, has been the idea that by creating new industry leaders or companies that are in the top handful of CROs, that you enhance the value proposition of those companies, and that the industry is moving in a direction where strategic partnerships, global capability, these are all important attributes. And so there's been a number of transactions that have been with consolidation in mind, and with the idea of taking players that are not in the top 5 and putting them together to get them into the top 5 and participate in this strategic and globalization process that's going on. There's certainly other strategies. My firm, Warburg Pincus, recently invested in Research Pharmaceutical Services, RPS, a CRO, really with a very different kind of strategy, and that was the notion that there are multiple models within the CRO industry, and a number of very strong leaders in delivering project-based services to the industry. But RPS, as I think many people here know, has pioneered a different kind of model, which brings value to companies across the spectrum, but historically has delivered great value to large pharmaceutical companies in helping them think about how to drive efficiencies and outsource really that portion of their clinical trial operations that they've historically been reluctant to outsource. So how to help pharma companies think about how you get beyond 35 to 40% outsourced, and how are we going to get to 50, 60, or 80 or 90% outsourced and drive the efficiencies and flexibility that goes along with that. So I think every transaction has a different set of strategic thoughts and strategic rationale behind it. Ultimately, it's all about participating in and driving the growth of this industry and improving operational performance to deliver returns.
So I'm gonna skip the second to last question. We just had I think you've talked about it a little bit. maybe not quite so, but I think the last one is a really important one. You know, your expertise, Wall Street's expertise is finances. Obviously, you go in when you do your due diligence, you're looking at the books, you're running the numbers, you're making sure the investment makes sense. But once you say, yes, this makes sense, you acquire the company, how involved are you in the day-to-day operations? You know, do you recognize this is not our expertise? We're going to let the folks who are there run it? Or, I mean, I'm sure it's a mixed model, but can you talk a little bit about that?
Sure. Well, again, there's not a single answer to this because there are different private equity firms with different philosophies and different strategies. There are some private equity firms that institutionally hire as partners of those firms operating executives and so the model is to become more actively involved in the operations of those companies and try and have that expertise on their staff internally within the private equity firm. For Warburg Pincus, that is not our model. We are financial investors, and we know that we're financial investors. We know our limitations. So we view our investments as partnerships with management, and we're backing management teams that we believe know how to execute and know how to deliver value in the industry, trying to provide them with the capital they need to succeed and with strategic advice and input when we can. But ultimately, we don't run companies. We finance companies, and we look to management to run them and make the day-to-day decisions.
Great, thank you. So next we're going to move over to Michael Martorelli, who is an investment banker from Fairmount Partners in West Conshohocken, Pennsylvania. And Mike's role is to help companies find purchasers and to close the deal. So he'll talk a little bit about how that works, how deals should be structured and such. So you've heard from the Wall Street side. So it'll be interesting to see what Mike can add here and talk a little bit about once the deal's made or making the deal.
Making the deal. You can show that slide again. What I've put together here is just a handful of not so miscellaneous, but a range of miscellaneous notes from what I'll call the M&A wars, which really aren't wars, they're negotiations. And I will point out that probably for every one name brand private equity takeover of a PharmaNet at the time, or an RPS at the time, or a PPD at the time, there are probably 20 acquisitions that Quintiles bought something smaller, or Icon bought something smaller, or MedPace bought something smaller. And that's kind of the bulk of the M&A world. Some of the sectors are hot at any given point in time, and some are not. I mean, today, regulatory and commercial consulting seems to be very hot. Post-approval studies, very hot. Preclinical tox, not so hot. So that's just a reality of life. Depending on where you are, you may be in a sector that hasn't had a lot of M&A because it's not hot. I really wanted to spend more time, and I'd be happy to talk about it afterwards and after the conference or later on, about talking about the basis for valuation. Without stepping on Jonathan's toes, who does this for a living, we do it for a living too, from a different point of view. And we like to point out to the clients, our sell-side clients or our buy-side clients, yes, it's about the numbers. It's about the performance and the projections and the comparables. But don't forget, Mr. and Mrs. Entrepreneur out there, that the structure, the terms of the deal, things like the funding source, the escrow, the indemnification, the extent of non-competes, the working capital adjustments, there are dozens of lists of structural items that can be just as important and maybe even more meaningful to that deal than the valuation. So if you just look at the valuation comparables and say, well, I should get 8 times EBITDA because that other guy got 8 times EBITDA and I'm even better than him, maybe I should get 9. Yeah, but if it's a bad structure, if there's too many on-the-come payments, if there's ill-defined earnouts, it's not necessarily the right structure, and a good banker should guide you through that. A second item where a good banker should guide you through the process is to really understand the importance of market intelligence. It's not just the good bankers in this very tightly defined world are not just business brokers dialing for dollars. If we're going to call Jeff at PharmaNet with a specific acquisition, we're going to know something about what Jeff has told us about the kind of things they're looking for. Not confidential material, but we're just talking every day to the buyer community out there. And again, any good bank is going to do the same. The entrepreneurial small company interested in maybe selling to Quintiles needs to know and it's our role to tell them that, well, Quintiles just bought one of those kind of companies 6 months ago. They're probably not going to be interested in you. So understanding the importance of that market intelligence is something I really wanted to emphasize. And that drops down to the 2 bullets later when you talk about most likely roadblocks to a successful transaction. What's the number 1? Miss your numbers. Miss your numbers and you've got a giant roadblock. But number 2 is if you've misestimated or underestimated or just not been in tune with the buyer's intentions, the buyer's doing other things that he's not necessarily telling you about. I hate to pick on Jeff, but Jeff will say, oh yeah, we want one of these. And when we finally tee him up and show him one and go down the path, we'll say, oh, by the way, we're not going to do that because we just bought one of those and we're busy with that. So you really have to appreciate that that is an issue and try to understand that as much as you can. Again, a role for the banker, but a really important nuance that the entrepreneur, Mr. or Mrs. Entrepreneur, really ought to think more about. Ian, I could spend the rest of the night talking about the differences between strategic and financials and tuck-ins versus platforms and other things. Let me just close by touching that due diligence bullet, and I'd be happy to defer to guys on both sides of me who've been deeply involved in it. It seems to us, from our perspective, that it's more detailed than it's ever been. It's more extensive than it's ever been. It's outsourced more than it's ever been. So you get maybe some generic due diligence firms that are not necessarily experts in operating factors of a clinical research company. You've got to have all that data lined up and prepared to go very quickly. That's just another note from the M&A wars. Something that can really slow down a deal is not being prepared to answer the due diligence questions of the buyer, whether it's a financial or a strategic. Again, I could talk the rest of the night of those things. I'd rather save some time for questions and interactions.
Yeah, I appreciate the info. Very interesting stuff. So we will end by turning it over to Jeff McMullen, who's lived through all of the things you've just heard my previous 4 colleagues up here talk about. So I have a series of questions for Jeff, so I could throw those at Jeff, but I know Jeff also has some notes, so we'll let him run through and talk about.
Well, I'm actually going to answer your questions. Okay.
Great.
So,
and I'm sure you can answer a lot more given what you've been through, I've heard.
But I just want to know, did I really say it was a this when it was a that? Did I do that, Dave?
Or was it that or this?
I
mixed them up.
So the first question has to do with benefits and challenges of being public versus being private. And I think maybe to get a little more specific, I want to give you a little perspective based on the history of PharmaNet, and I think that will, people have alluded to that today, but let me just give you a little bit of the history so you understand what we've dealt with. The company was founded in 1996. I'm one of the founding shareholders. We began as a private company, obviously. And ultimately, we went public through an acquisition. So we kind of backdoored into becoming a public company. And then in 2009, we were taken private by a private equity firm, JLL. And in July of last year, we were acquired by Inventive Health. And Inventive Health is owned, backed by a private equity firm, T.H. Lee. So over the years, we've had experience with being private, being public, being purely a private equity owned organization, and now kind of a combination strategic private equity. So Inventive Health, for those of you who don't know the company, is a 13,000 person company, $2 billion in revenue, operates in 40 countries in 3 divisions. The division that most people are familiar with is the commercial division, which is involved with sales, marketing support, advertising, training, and branding and brand management. That's about half of Inventive. There's a smaller piece, which is the consulting division, which is Campbell Alliance, involved in consulting for pharmaceutical companies. And then the third piece is the clinical piece, and that is really now PharmaNet i3. So the clinical piece is also about half of Inventive. We have about 6,500 people in clinical, which makes us now a top 5 CRO. So that's the combination of the legacy Inventive Clinical Services Group, i3, which was carved out of United Health, and PharmaNet. So that's kind of, the background. And just maybe to comment on, my experience during those transitions, there were obviously challenges, opportunities in both being public and being private. Maybe it's a surprise for me to say that there are probably more similarities and differences in those different ownership configurations. Each, of course, is an ownership structure. The plans and the growth strategies are clearly based on the needs and expectations of the owner, to Jonathan's point. That can differ depending upon circumstances, but ultimately those needs are pretty similar. And what I found is the differences have to do mostly with the timing and the execution strategy and the reporting requirements in those different ownership configurations. So as a private company, originally we, management, were the owners. And there the needs and objectives were much more personal and really much more entrepreneurial. And what we were focused on was building a business, building a name, building a client base. And for us, as a private company, at least in the beginning years, growth was much more important than profitability. We wanted to, create a position in the industry. Now, as we grew the company, ultimately profits began to become more important, but clearly it was all about growth and building something in the beginning. Then, as a public company, obviously the shareholders were the owners, and the needs and objectives there were largely driven by enhancing the share price. And things like book to bill and things like EBITDA were primary indicators that encouraged the share price up or down. But there were also less tangible, what I call emotional factors, that could drive share price, rumors and supposition about what was going on. Less tolerance for investment in that environment. And I think that those of you who followed recent announcements by Covance with some of their large IT investments, have probably seen evidence of that. So then, as a strictly private equity-owned company, needs and objectives there were first and foremost EBITDA enhancement. And the focus was on financial discipline, improving financial performance, improving EBITDA, because for them, the objective was to sell the company and make a profit, as Jonathan said. Now we're in a situation where we have a strategic owner backed by a large, very successful private equity firm. So it's Inventive Health, backed by T.H. Lee. To me, this is kind of the best of all worlds. And I'm not saying that because somebody from T.H. Lee or Inventive is in the room. I'm saying it because it's true. And I say that because the needs and objectives here are much more strategic. It's about growth. It's about long-term thinking. It's about financial performance. But ultimately, it's about how we position the company in the industry. Clearly, we're now a top 5 player. That was the strategy in bringing these 3 companies together, to be more competitive for a lot of these strategic deals that are out there. Now, although we are private equity owned, we still have shareholders. Those shareholders expect a return on their investment. They expect information. We're still a highly transparent organization in terms of conveying our performance to our shareholders. We still have quarterly calls with bondholders and lenders. So that part hasn't changed all that much. But again, I think what's changed is the more strategic approach. And one of the great advantages is what I call collaborative capital that is offered to PharmaNet i3 by this environment we're in. And what I'm referring to there is the experience of the management team of Inventive. Paul Meister and his team are able to provide support to the PharmaNet i3 division. T.H. Lee is able to provide expertise and support. And what we're seeing is a much higher degree of flexibility. We're not so focused on the quarterly results Yes, we do report quarterly. Yes, we don't want to disappoint shareholders, but we do have the ability to think a little more long term. And we're finding that in this environment, there's an encouragement to make investments, to grow the organization, to advance the position in the industry. And it allows us to adapt to the rapidly changing environment with clients. So that was a very long answer to your question, but that I think is the gist of what I've experienced.
So I think in the interest of time, if we could just jump down, the one thing that we haven't focused on too much is the sponsor or customer perspective. So can you talk a little bit about how PharmaNet's customers reacted when they heard that you were going from a private to a public and then back to a private and then private again? Can you talk a little bit about that transition and the types of questions that they might have thrown your way, or if you lost business because of that transition?
Yeah, it's a great question, and clearly change is always a challenge. It's a challenge internally. Employees don't like change. Clients don't necessarily like change. So, we were cognizant of that, and I think we managed that well. It's really a matter of being clear and articulating what the advantages are in this new organization or in this new environment, depending upon, which transition we're talking about. So we took a very proactive approach in all instances involving client outreach. Again, what is the new organization? What are we trying to accomplish? What's in it for you, the client? And why is this a good thing? And what's in it for the employees? And why is this a good thing? So our approach was really a three-step approach. The first is to focus on business continuity. We felt we did not want to change anything for our clients. We didn't want to change project teams, project managers, processes, or systems, so that for them, there really wasn't a change. They didn't feel a change, and I think that was successful. So to answer your question, we didn't lose a single project. We didn't lose a single client, and I think it's because of the proactive nature that we took. The next step after the continuity focus is a harmonization, a focus on harmonization, which really means identifying best practice, best systems, best processes in these three companies, and offering those in a consolidated, organized fashion to clients. And we're pretty much through that phase. And again, it's been well received, well accepted. We're not forcing clients to pick new systems. We're sticking with what they have, but offering options as well. The third step for us is what we call optimization, and that's really our effort to become best in class in everything we do in the industry, and that's what we're working on now.
So I think you've touched on a lot of the other questions that we had posed here, just in your answers, which have been great. So the last question I have, and it's a very short answer, what's more challenging to manage expectations for? When you were publicly traded in Wall Street, or being privately held with your private equity investors now?
Well, great question. The most difficult thing was managing the expectations of Eric Caldwell and David Windley. But no, seriously, the intensity of the pressure in all of those different configurations that I mentioned really doesn't differ. The pressure is the same, regardless of who the shareholder is, who the owner is, what the configuration is. What I did find, however, is that the pressure is, I would say, a little more rational in a private setting than it is in a public setting. And I think that's largely because in a private setting, the owners are involved in developing the strategy. And they can see on a day-to-day basis how we're executing against that strategy. So I just think there's an inherent higher level of comfort, whereas getting the public markets to kind of understand the strategy and support the execution, I think, is a little more challenging. So pressure's the same, but the rationality of being private, I think, wins. Okay?
Thanks a lot, Jeff. Yep. So I did have a slide and was hoping to be able to give the sponsor perspectives, but given We're a little bit over. I was told that we could go a few minutes over. Maybe I'll just start by throwing some of the questions I had from a sponsor's perspective towards some of you guys. So this will be an interesting one for maybe Dave or Eric or Jonathan. Do you think that consolidation is going to continue in the CRO space? Have we seen a majority of it? And I'll tie it into my second question, which is, will consolidation spill into the other areas of clinical trials, such as central labs, ECGs, imaging, and the other ancillary service providers that we use to make our trials successful?
You go ahead.
I think a year ago I wrote that investment bankers will be busy. I think was a paragraph in my summary of this event. Investment bankers will not be so busy for the next year. Mike will be, because he focuses on smaller deals, but the bigger deals are going to slow down, and I think you're going to see a moderation there on the large side. It's going to be hard to consolidate some of the, I call them applied technology vendors, or e-technology in some cases. It's going to be hard to consolidate them because they need to be vendor neutral, and in most cases.
So the CRO consolidation is done. Is that so? Are you saying, you're speaking in general terms, where you're not going to see that with the other?
The size of Jonathan's or higher are largely complete at this time.
What about other ancillary service providers who may not have the tens or hundreds or even billions of dollars of revenue with some of the deals we've seen?
If it's a service that also sells deeply into the CRO industry, there's going to have to be some co-opetition here. I think that's going to be very difficult for one CRO to own those services and continually do well with them. So there are some, what I would call, vendor neutral activities that need to be separated from a sole owner.
Gotcha.
So, Ian, I was going to add that what Eric's referring, dovetailing off what Eric's talking about, what he's referring to is that difficulty of a CRO or an ancillary service aligning with a particular CRO and then potentially risking its business with other CROs. So where, I guess as an overarching theme, I think that we can say with some confidence that the buyer of the services wants simplification. They do want to be sourcing their services from fewer vendors, simplicity of contract, some purchasing power, of course, in that activity, in that effort. And so that does encourage some banding together of some different services. I think the difficulty is that you maybe can't cross-pollinate buckets. So if you're a clinical service provider seeing some aggregation of other clinical service providers, that may make sense. But having a CRO go out and, let's say, buy metadata in the EDC and other technology space, that gets pretty complicated for the reason that I highlighted a minute ago. So to your question, Ian, we may see more aggregation of common ancillaries. We may see more aggregation of clinical service providers, or what we think of in the public equity markets as CROs. But the likelihood that we see banding together across those buckets is less likely. Another area that I've always thought, and Jeff has talked about, is going back to his days as a public company, were clinical trial materials supply and contract manufacturing, that type of supply chain in the clinical trials industry. And it's always been a little curious to me why the CROs didn't get more deeply into that side of the R&D spending bucket. But that's yet another bucket that seems to have remained on its own island, that is separate. So I'll stop there.
So my next question, which will be my last before I will ask a few questions of the audience, and just maybe 2 or 3 given our time constraints, but, and this is really just a general question, how many partnerships do CROs have to form, and maybe this is for Jeff, in order to achieve their financial goals? And we know there's still some publicly traded companies that are forming these strategic partnerships where, a sponsor company only picks 1 to 3 companies to do their work for them. But are the private equity firms, so Jonathan, maybe even you can chime in, are you guys coming in and saying, we need you to have 5 strategic partners with X amount of revenue in order to maintain our profitability margins and keep the price high for when we look to liquidate and sell you off?
Want me to start?
Sure.
All right. My answer is it's not the number of the relationships, it's the type of the relationship that's really important. Obviously, primarily measured by profitability and potential for long-term growth and efficiency in developing efficiency. So I don't think there's a magic number, but I think you need to have a good balance between strategic relationships, strategic, preferred provider relationships, and everything else. So I don't think it's all of one, and I don't think there's a specific number.
And I asked that question really because if you looked at one of the slides earlier that David and Eric presented, you saw that sort of cliff on that chart fall off with profitability. So it's just interesting because all the private equity firms have come in and gobbled up these CROs because they were so profitable. But now that these strategic partnerships are being formed, we clearly saw, and from a sponsor perspective, dealing with this on a daily basis, I see that the profitability is just not there, and the horizon to getting to where you were is much longer. So do you guys have any input into that, into what type of partnerships or how many, or maybe even diving into my other question, what types of contracts the CROs could enter into?
Well, I think this whole issue of strategic partnerships is wielded by CROs in part as a marketing phenomenon as much as a real phenomenon. It's a very real phenomenon, but when I say marketing, I mean marketing to investors. So companies will tout the number of strategic partnerships they have or the strategic partnerships that they enter into. And what you learn as an investor, and I think the public investors as well as the private equity investors understand this, it's not the number of strategic partnerships, it's what is the content of those customer relationships and what is the value that's being provided to customers. So a strategic partnership can be a signal of a recognition by a client that a CRO has a strong reputation and a value add. It can also be a recognition that CRO bid themselves down to the lowest possible price in order to get into the preferred provider relationship. So you really have to look carefully at what the relationship is, and we as an investor, when we look at these, we try to be careful not to believe that these strategic partnerships are somehow going to go on forever. They may not even go on that long. I mean, there's a lot of moving around of the deck chairs and a recognition that even strategic partnerships don't mean 100% of the business of that pharma company goes to the so-called strategic partners. It's really a license to begin a dialogue as opposed to the end of a dialogue. And so it's far more complicated than the sort of simple math would suggest.
Yeah, we all know it's complicated. So in the interest of time, I will just take 2 questions from the audience so we can wrap this up. And there is a thank you slide that has all of our contact information here. So if you guys would like to reach out to any of us to discuss anything we've discussed today or in the future, you can feel free to reach out to us, and there's all of our information. So there's 2 questions. Does anyone have any questions for us up here, either as a group or individually?
There's one coming back.
Hi, my question is regarding vertical integration in the industry. It looks like some CROs have invested in clinical research sites, and in that business specifically, it seems like early phase research.
Can you talk a little louder, please? We're having a hard time up here hearing you.
Sorry. My question is regarding vertical integration in the
Louder,
industry.
please.
Oh, sorry. My question is regarding vertical integration in the industry. It looks as though some CROs have purchased clinical sites, and specifically early phase, and have kind of gotten into that business. Can you comment on that just a little bit, and also the attractiveness or unattractiveness of sort of the clinical site side of the business?
We're all looking at you, Jeff.
Thank you. Well, I mean, the idea of purchasing sites is not actually a new idea. That was something that was experimented with, I'd say, 10 to 15 years ago. I think it's a model that was not particularly successful for most who endeavored to, try it. But there are still some out there that I think have done it successfully. So, that's one example of vertical integration. There are other examples, and David was touching on some of those. I think there are other opportunities to pull together other aspects of the clinical development process under the CRO umbrella, things that are now kind of commonly outsourced, third party, I think would benefit from being consolidated under a single umbrella, because I think we can find efficiencies as data kind of transfers along the continuum. So I think there are opportunities. I'm not sure that the site model is necessarily the best model, but there are others.
Great, thank you. Any more questions? And just a quick check, are we okay on time? I know there's something going on. Okay, this will be the last question then.
I suppose the question I have is a bit provocative, and it's probably addressed to the private equity and the investment banking members of the panel. Given your view that these investments are so attractive from an ROI perspective, and we hear private equity as the name given to your industry, why do we see a capital structure that has very little equity, and why is the organization of the actual transaction such that these highly levered deals end up finding their way onto the books of the CROs that are purchased, instead of a high level of ownership being maintained by the private equity firms?
I didn't.
So sorry,
I didn't quite follow.
couldn't quite
Are you
quite hear
asking-
the question.
Yeah, I'm not sure I followed that, and I'm not sure I'm the guy to answer it anyway, but are you asking why private equity firms are not taking a larger share of ownership?
Yes, the debt typically in these transactions ends up being on the books of the CROs themselves, instead of having a deal where the majority of the investment's equity versus debt. So I'm just asking, if the attractiveness of these companies is so high, why is the financial skin in the game for the private equity investors not higher?
You guys have a...
So I guess, chime in for Jonathan, they are still buying 100% of the equity. After the transaction is done, they are the sole owner of the company, and they are using debt to lever their return even higher. So it's essentially inherent to his model that you're buying a company that generates that relatively predictable cash flow, as he described earlier. That predictability of cash flow both affects the cost of debt capital, will be lower, and two, predicts the repayment of that debt. And as the cash flow from the business pays down the debt, they accrue into even more equity in the business. So that's part of how you're able to lever your equity return even higher. So they still, I guess maybe the embedded disconnect there is that they're using debt, but the equity is wholly owned by the buyer.
Also, we're seeing deals go at up to 6 to 6.5 times leverage, which is, in historical context, at the higher end, while interest rates are at the lower end. So the higher the leverage taken on, it shows a higher level of confidence by the buyer. It leverages the investment, but in a historical context, debt is exceptionally inexpensive right now.
We are on borrowed time here, guys, so I am going to have to say.
Well, I'll stay over here if anybody.
So yeah, if my colleagues up here on stage have the time, maybe we can just scoot out the exit doors right here. So if folks would like to come out and ask more questions, we'll do that. But I would like to thank my panelists. Great job, gentlemen. Hopefully it was intriguing for you, and thank you all for attending.